Bank assets are all the assets and rights owned by a financial institution, such as a bank. These assets are essential for the operation and stability of the bank and can be classified into several categories. Here are some examples that are using bank assets: loans, sum of money that the bank grants to customers. Other examples will be reserve accounts, funds that the bank keeps in the central bank to meet the reserve requirements. Cash and equivalents, cash and short-term deposits that are easily convertible into cash. Proper assets management is crucial for the solvency and profitability of a bank. Regulators monitor these assets to ensure that the bank operates safely and efficiently. Some risks of these assets are credit, which happens to be that borrowers do not pay their debts. Another will be the liquidity risk, that is the inability to convert assets into cash quickly without losing value. The nature of the bank's account is that it's debit balance account. When is the bank's account debited? The account is debit when the money enters the bank, meaning the company receives payments from customers, a cash deposit is made, or a bank loan is received. Banks are credited when money leaves the bank, meaning payments to suppliers are made or salaries are paid. The inventory asset refers to the physical goods stored in the company's warehouse, which are available for sale, production, and use in service delivery. It is reported on the balance sheet as a current asset because it is expected to be sold or used within a year, thus generating cash. Depending on company's industry, inventory may include different types of goods, like trading or commercial companies, manufacturing or industrial companies, and service companies. The accounting nature is that it's debit balance, debtor. This means the inventory count is increased with debits, it is decreased with credits. The inventory is debit when it's purchasing inventory and it returns goods from customers. And it's credit when the sale of inventory, which means goods leave warehouse, and loses spoilage, shrinkage, and theft. The value of inventory can be calculated using different methods. These affect how much is debited or credited from the account. It's important because of its operational control, that its poor inventory management can lead to lost sales or unnecessary costs, and because of the accurate COGS calculation. And it affects profitability through the level of inventory and its turnover. The advertising account records all expenses related to promotion goods, services, or the company's brand. This includes ads on social media, TV, radio, newspapers, digital marketing like Google Ads, Facebook Ads, etc. Printed materials like flyers, posters, and magazines, and outdoors advertising like the billboards or digital screens. This type of account type is expense, and the nature is that it's debit. It's debit when it increases, that it's when you incur the expense, and it's credit when it decreases, when you reverse or cancel the expense. In many countries, advertising expenses are tax deductible, provided that they relate directly to the business activity and they are properly supported by invoices and proof of payment. They don't exceed certain limits, depending on tax regimes. Advertising is a cost incurred to generate future income, even though it doesn't produce an immediate sale. It's not capitalized because the benefit is uncertain, the value is not reliable, measurable, and it's consumed in the short term. However, some long-term brand development costs may be capitalized under certain accounting standards. Land is a non-current asset that represents the value of any land owned by a company. It includes lots, parcels, farms, or any plot of earth acquired for business use, commercial, industrial, agricultural, etc. Some common examples is a plot of land for future factory construction or a land for office expansion. This account type is a non-current asset and its normal balance is debit. Land is not depreciated because it does not lose value due to usage. However, it can be revalued or impaired under some accounting standards. It's debit when it increases land value when you acquire land, and it's credit when you decreases land value, like sale, disposal, or correction. Land is classified as a tangible asset. Under US GAAP, land is always measured at historical cost and revaluation is not allowed. It can have costs related to acquisition, like e.g., title fees, service, and permits, and these are capitalized into the assets. The transportation equipment account represents the value of vehicles owned by a company that are used to carry out its business operations. This may include delivery vans, trucks, company cars, motorcycles, etc. This account type is non-current asset and its normal balance is debit. This type of account is debited when the company acquires, receives, or upgrades transportation vehicles, that is, when the asset increases. Some examples is when they purchase of a new delivery truck or a vehicle received as a capital contribution. And it's credited when the company sells, writes off, or transfers the transportation equipment, meaning the company no longer holds the asset. Some examples is when the sale of a company car or retirement of a damaged vehicle or a donation of a vehicle to a third party. Transportation equipment is depreciated over time due to wear and tear. Depreciation is recorded periodically under accumulated depreciations. While this asset may not generate direct revenue, it plays a key role in supporting business operations, e.g., distribution, sale, logistics. The accounts payable account represents the people or companies to whom money is owed for the purchase of goods services on credit. In other words, it's when you buy something but do not pay immediately. It is recorded as a debt with a supplier. The type of this account is liability, and its classification is current liability. Normal balance is credit. It is credited when you purchase goods or services on credit, i.e., without immediate payment. And it is debited when you partially or fully pay the amount owed to a supplier, reduces the debt with the supplier. Some types of transactions that are recorded in this account, it's the credit purchases, that it's goods, materials, or services. The payments to suppliers, the purchase returns, when goods are returned to the supplier, and the discounts or allowances granted by the supplier. The importance of managing accounts payable effectively is that it's cash flow management, it's supplier relationships, it's financially reporting, it's avoiding penalties. That all of these are things that are really important to know how to work with this. The sundry creditors account is used similarly to accounts payable, but it is meant for debts that are not related to regular suppliers. In other words, it is used for debts to other entities or people. The classification of this account is current liability, and the normal balance is credit. Increases with credits, decreases with debits. This is account credited when the company incurs a debt or obligation to third parties that is not related to regular purchase, such as a loan, taxes owed, or payables to employees or other entities. And it's debited when the company makes a payment or partially settles the debt or obligations. In other words, the account is debited when the debt to the third party is reduced. It has relationship with other creditors like the bank, cash, short-term loans, salaries, and the wage payable. Customer advances, also called advances from customers, are amounts of money received in advances from customers before the delivery of goods or the completion of services. It represents a liability for the company because it owes goods or services to the customer in the future. Its classification is current liability, and the normal balance is credit. The account is credited when the company receives money in advance from a customer before delivering the goods or services, and the account is debited when the company delivers the goods or services and recognizes the revenue, reducing liability. This liability is important because they represent funds received before earning revenue. They should not be confused with sales revenue until the goods or services have been delivered. Advances can help improve cash flow, but also create an obligation to deliver. The VAT payable is an account that records the value-added tax that the company must pay to the tax authority for the sales made. In other words, when you sell a product or service and collect VAT from your customers, that tax is not your income, but money that must be reminded to the government. Its normal balance is credit, and its classification is current liability. The account is credited when the company receives money in advance from customers before delivering the goods or services, and is debited when the company pays or credits VAT to the tax authority or when it has the right to recover input VAT. VAT payable reflects only the VAT that the company must pay after applying the input VAT. In some accounting systems, a separate account called input VAT is used to record the VAT paid on purchases. VAT payable is a liability because it is money that the company owes to the government. The mortgage payable is a long-term liability that a company or individual has with a financial institution, usually a bank, and it's secured by a real estate property, such as a building or land, as collateral. This debt is repaid in periodic installments and typically carries either a fixed or variable interest rate. Its classification is non-current liability, and its normal balance is credit. The mortgage payable account is credited when the company incurs a mortgage debt, that is, when it receives the loan from a financial institution to finance the purchase of a property or real estate. And it's debited when the company makes a partial or full payment toward the mortgage. Mortgages are typically long-term loans, often lasting between 15 and 30 years, though some may be shorter. The repayment term determines the periodic payments and the condition of interest rate. This is divided between the payment of principal and the payment of interest. Mortgage is typically secured by a real estate asset, meaning if the company fails to make payments, the lender can seize the property to satisfy the debt. Mortgage payments affect the company's cash flow as they involve an outflow of cash or bank funds. Additionally, the interest payment is recognized as a financial expense in the income statement. The mortgage payment, it has an impact on financial statement like balance sheet, income sheets, and cash flow statement. The legal reserve is a portion of a company's net profits that must be set aside by law, typically to protect creditors and ensure the financial stability of the company. It cannot be distributed to shareholders as dividends, and it's tended to cover potential future losses or preserve capital. This requirement exists in many jurisdictions, particularly in civil law, countries such as Spain, Mexico, and others in Latin America and Europe. Its natural balance is credit, and the type of account is equity. The legal reserve cannot be used freely. It is typically only used to offset accumulated losses when no other reserves or retained earnings are available, and when it is going to be reclassified in certain cases where company capital is being restructured. The legal reserve is credited when it is created or increased, usually at the end of the fiscal year from the company's net profits. And it's debited only in exceptional situations such as to cover losses when no other reserves or retained earnings are available. The retained earnings represent the portion of net income that a company keeps after paying dividends. These earnings are reinvested in business or held as a reserve for future use. Its classification is unrestricted unless stated otherwise. These earnings are credited when the company earns net income during the year and when it adjustment increase prior profits. And it's debited when the company pays dividends to shareholders and the company incurs a net loss. Also, it when adjustments reduce pure earnings and transfers are made to legal or other reserves. It is shown in the equity section of the balance sheet and usually labeled as retained earnings or accumulated profits. They do not represent cash, they reflect cumulative accounting profits, and a company can have negative retained. It is often used to finance expansions, equipment purchases, R&D, and debt repayment. Cost of sales represents the direct cost incurred in producing or purchasing the goods that a company sells during a period. It includes raw materials, direct labor, manufacturing overhead, and purchase cost of merchandise. It is debited when goods are sold and transferred from inventory to expense, and it becomes part of the income statement as an expense. And it's rarely credited except in adjustments such as return or reversal of an incorrect COGS entry. It appears on the income statement just below revenue and used to calculate gross profit. Cost of sales is a key indicator of operational efficiency, affects gross margin and net income, and must comply with matching principle. Expenses are recorded in the same period. Financial expenses refer to the cost associated with borrowing money or managing financial obligations. These are non-operating expenses and are recorded in the income statement. Some examples of financial expenses is the interest on loans or bonds, bank fees and charges, foreign exchange losses, penalties for late payments, and leasing interest. It's debit when it is incurred or recognized, such as interest paid or accrued. And it's credited when it has a correction, reversal, or adjustment is made. Its normal balance is debit, and the statement is income statement. Financial expenses do not include operating costs like salaries, rent, etc. They can significantly impact profitability, especially in a highly leveraged companies. Sales represent the revenue a company earns from selling goods or services during a specific period. It's one of the most important components of the income statement as it shows the company's main sources of income. Sales are credited when a sale is made, whether for cash or on credit. And sales are debited when there's a sale return, discount, or correction. Its normal balance is credit and its account type revenue. It appears at the top of the income statement, typically the first line as sales, revenue, or net sales. Sales can be gross or net. Gross sales, total sales before returns, discounts, etc. And net sales is when gross sales minus returns, discounts, and allowances. There are several types of sales. Some of those are cash sales, credit sales, online sales, wholesale, and retail sales. Sales are crucial for measuring business performance, calculating profit margins, and evaluating growth over time. This is all, and I hope you like the video and the topics I presented. My name is Sofia Victoria Martinez Marquez from group 621 10I. Thank you for watching and I hope you like it.